All right, let's really dig into this stack of documents. We've got a fascinating deep dive requested by you, our listener, into a company that's absolutely central to the plumbing of global finance.
Indeed. The material here focuses on a major player really exploring their business, how they operate.
The financials.
Exactly, the financials and, critically, the layers of risk they navigate and, manage every single day.
Think of this as getting a detailed look under the hood of a vital piece of global financial infrastructure.
Mm-hmm.
Our mission today is to cut through the noise, extract the most important nuggets, understand what they do, where the money comes from.
And what keeps them up at night?
Precisely. And based only on what these sources tell us.
Right. Stick to the material provided.
So let's jump right in. At its core, who is CME Group and what business are they actually in?
Okay. So based on the material, CME Group stands out as a major global exchange and a crucial central counterparty clearing provider.
Right, the clearing piece is huge.
It is, and they offer this vast array of what the source calls global benchmark products. Think all the big asset classes. Interest rates, equity indexes, foreign exchange.
Commodities, too.
Yes, and commodities like agriculture, energy, and metals, a really broad scope.
And it's not just the derivative side, the futures and options they're famous for, is it? The sources mention cash markets, too.
That's right. They specifically highlight their cash and repo fixed income trading handled through BrokerTech.
Okay.
And their spot and OTCFX trading via EBS, so multiple types of venues.
One thing that jumps out repeatedly in the material is this concept of market liquidity. Why is that so, fundamentally important for a company like this?
It's fascinating how explicitly the source links liquidity, the market's ability to absorb big trades quickly without prices going wild.
Right, without moving the market too much.
Exactly. It links that directly to their success. It's essential for attracting and keeping customers.
Makes sense.
I mean, if you're a large institution needing to hedge a big risk, you need confidence you can actually get that trade done efficiently. Liquidity gives you that confidence.
And the range of risks they cover through their products seems massive. What are some of the key examples the sources list?
Oh, the list is pretty extensive. For interest rate risk, you find SOFR and Fed funds futures and options mentioned.
Okay, the benchmarks.
Yes. In equities, they list products tied to major indices like the S&P 500, the smaller micro E-mini contracts, NASDAQ 100, FTSE Russell, Nikkei.
Even crypto?
Yep, they're in crypto too, with Bitcoin and Ether futures and options listed.
Wow.
Then you have commodities, U.S. Treasury futures, staple agricultural products like soybean, corn, wheat.
The classic contract.
The classics. Plus global FX major and emerging market currencies, spot precious metals, NDFs. It covers a lot of ground.
So quite a list. Any specific changes noted?
Yeah, one specific note in the material is that FX forwards and swaps on that EBS platform stopped trading back in April 2024.
Okay, good detail. So they provide the venue and the products for trading huge volumes across the globe. How does that translate into revenue for CME Group?
The material is very clear on this. The vast majority of their revenue comes from clearing and transaction fees.
And these fees are essentially tied to how much is traded, volume-driven.
Precisely. Primarily volume-driven, usually charged per contract or based on the notional value of the trade.
So their financial results are directly impacted by trading activity.
Directly. How much activity happens on their platforms really matters to the bottom line.
So during turbulent times, like, say, economic uncertainty or geopolitical events, does volume tend to go up or down? What do the sources say?
They indicate that volume generally increases during those periods.
Ah, interesting. Because people need to manage risk more.
Exactly. That's when customers are most actively using these markets to manage volatility, either hedging existing exposures or, through speculation.
Okay, but beyond just the raw volume numbers, what else influences the revenue from those fees?
The documents list a few other factors. The specific fee structure they have in place, for one.
Right.
The mix of products being traded, some might have higher fees than others.
Makes sense.
Also, the particular trading venue used, and even the type of customer. Members usually get better rates than non-members.
Oh.
And they have things like tiered pricing and incentive programs that can tweak the final fee amount.
Got it. So transaction fees are the main engine. What other ways does the material say they make money?
Another significant stream is market data and information services.
Selling the data generated on their platforms.
Yes, selling access to real-time and historical trading data, providing analytics. And importantly, licensing the use of benchmarks like CME term SOFR for other financial products.
Okay.
They also earn from access and communication fees, managing collateral for clearing members, equity membership subscriptions, and various strategic relationships mentioned.
Right. Looking at the other side of the ledger now, what are the main expenses highlighted in the sources?
Well, the sources note that unlike revenue, most expenses don't directly scale up and down with trading volume.
Okay, more fixed in nature.
Largely, yes, though some licensing agreements do have a volume component. The single largest cost category they point to is compensation and benefits.
People costs.
Exactly. Wages, bonuses, stock-based compensation, benefits for their global workforce. That's the big one.
And the other big buckets of cost.
Technology is a major one, which, makes sense given their business.
Absolutely.
Then you have professional fees and outside services, amortization. Those licensing and other fee agreements we mentioned also show up as significant expenses.
Right, the fees they pay out.
Yes. And then there's a general category for other costs like office space, marketing, and even legal expenses.
Okay. Let's pivot a bit to growth and their product strategy. The sources suggest they're constantly evolving their offerings. What are some examples?
Yes, the material definitely highlights that. Recent product extensions, for instance, like introducing more short-dated options across different asset classes.
Oh, yeah. Like what?
We're talking treasuries, WTI crude oil, gold, silver, copper, and even Bitcoin futures options. More granular ways to trade, basically.
Interesting. And expanding their reach.
Yeah, a clear strategy mentioned is expanding and deepening their customer relationships globally, really pushing that international side.
Do the documents give us any specific numbers showing that international footprint?
They do, actually. For 2024, the source says about 31% of their electronic futures and options volume came from outside the U.S.
That's significant.
And even higher for market data revenue, around 54% came from international sources.
Wow. Over half the data revenue is international.
Mm-hmm.
Did they see growth in trading during non-U.S. hours recently?
The material notes solid growth there in 2024 compared to 2023. European trading hours volume grew 17%.
17%. That's strong.
And Asia-Pacific hours saw 7% growth, so definitely expanding activity around the clock.
And how are they driving this growth?
Well, they're actively working on adding new channel partners, according to the source, and looking for cross-asset opportunities, encouraging clients who trade, say, interest rates, to also look at their FX or equity products, getting more business from existing clients.
And providing tools to help clients navigate their markets. I think I saw something about that.
Absolutely. The sources mention specific tools, like the FX and metals market profile tools.
Where are those?
On their quant analytics platform, they're designed to help clients compare liquidity across different venues, different products.
To find the best place to trade.
Potentially, yeah. To help minimize trading costs or achieve better execution, helping clients be more efficient.
Now let's talk about the absolute bedrock of their operation. Technology, intellectual property, and key partnerships. How critical is the tech side, according to the sources?
The source material emphasizes that technology isn't just important, it's critical for everything.
Trading, clearing.
Trading, clearing, and ensuring the systems are resilient and available. Operational resilience is a key phrase used.
And they rely heavily on intellectual property, it seems.
That's a major point, yes. They depend on their own trademarks, patents, copyrights, data rights.
But also licensed IP.
Yes, and that's a particularly crucial area highlighted, especially for those major index products we discussed. S&P, Dow Jones, NASDAQ, FTSE Russell, they don't own those indices.
Right, so they pay a fee to license the right to offer futures and options contracts based on these indices.
Exactly. The sources detail these licensing agreements. They note that some provide exclusivity, like the S&P 500 futures and options license is exclusive to them.
And these aren't free rides, presumably?
No, definitely not. They pay a revenue share back to the index licensors based on the trading volume in those products.
Okay. And there's a notable partnership mentioned, isn't there? With a big tech name.
Yes. The partnership with Google Cloud stands out. The material highlights CME Group as the first derivatives marketplace to offer live market data directly on Google Cloud.
That sounds like a big step technologically.
It is, but it's interesting. The sources also connect this move to the cloud, including Google, to potential increased cyber risk, which we'll probably get to later.
Ah, okay. A trade-off.
Potentially, yeah. They also mention joint ventures, one with S&P Dow Jones Indices and another with OSTTRA, which show up in their financials as equity investments.
Makes sense. Now, in an industry like this, they're obviously not operating in a vacuum.
Yeah.
What does the material say about the competitive landscape?
The sources paint a picture of a large, ever-expanding, and intensely competitive global environment. It's not getting easier.
Who are some of the main rivals they specifically call out? Any names mentioned?
They list major exchanges around the world, Intercontinental Exchange, or ACE,
Right, a big competitor.
Cboe Global Markets, Euronext over in Europe, Hong Kong Exchanges and Clearing, Deutsche Börse in Germany.
Hmm.
The usual suspects, really.
But the competition isn't just from those established exchanges, is it?
No, and the material makes that clear. It also points to newer entrants, like BGC Group's FMX Futures Exchange is mentioned as an example,
Hmm.
and competition from alternative ways clients can trade or manage risk, using cash markets instead, or over-the-counter products, ETFs.
Or even keeping trades internal.
Exactly, or firms choosing to internalize trades rather than going through an exchange. The sources describe it as a highly dynamic space. New players, new technologies constantly changing the game.
Okay. Given the scale, the technology, their central role, managing risk must be absolutely paramount. The sources spent a lot of time on this section. How is risk framed?
It's presented as completely fundamental to their entire business model, right there in the risk factors section, and they face a really wide spectrum of risks.
Where do they start?
One of the first ones mentioned is tied directly back to their revenue model, market volume and economic conditions.
Right, so that volatility we talked about driving revenue can also be a risk. How so?
It's a bit of a double-edged sword, yeah. While uncertainty often boosts volume, the sources acknowledge that extreme market uncertainty or, say, severe economic distress could actually hurt volume if clients become too cautious or if capital becomes scarce. So a sustained drop in trading activity directly hits their bottom line. It's a dependency.
And they operate in a world just layered with regulation. That must be a huge factor.
Oh, heavily so. The regulatory landscape is described as extensive, complex, and constantly increasing globally.
Just keeping up must be costly.
Compliance itself is highlighted as a significant cost, yes. And then there's the ongoing risk that new rules or changes in how existing rules are enforced could force costly changes to their business practices or even their structure.
And the consequences of not complying if they slip up.
The source material lists some pretty serious potential outcomes: censure, significant fines, orders to cease certain activities, suspension of business,
Wow.
and even potentially losing their status as a regulated entity, like a clearinghouse or a swap execution facility, SEF.
Do they mention specific regulators?
Yeah, the documents mention specific regulatory oversight for platforms like BrokerTech and EBS across numerous jurisdictions: SEC, FINRA in the US, the UK's FCA, AFM in the Netherlands, CFTC for CEFs, MAS in Singapore, ASIC in Australia, HKMA in Hong Kong, Canadian regulators. It's a long list.
Okay, a complex web. What's next on the risk front? Something critical for a tech-heavy firm.
Absolutely. Operational resilience and cybersecurity, this is huge for them.
System reliability and keeping data secure must be, like, non-negotiable.
Totally critical.
Yeah.
The sources detail their vulnerability to targeted cyber attacks, the usual suspects like phishing, ransomware, but also mentioning potential AI-enhanced attacks.
Good new threats.
Plus, unauthorized access and failures in their systems. And these failures could stem from their own issues, problems with third-party vendors, simple employee error, or even natural disasters. Lots of potential failure points.
And what happens if one of those risks actually materializes? A successful attack or a major outage?
The potential impacts listed are severe: direct financial losses, obviously, legal liability, intervention from regulators,
And reputational damage?
a huge reputational damage, which is paramount for a trusted market operator like them. Given their central role, a successful cyber attack is explicitly highlighted as a significant risk not just for them, but for the entire global marketplace.
Do the sources say how they try to manage this?
Yes, they go into some detail. They have a global information security program led by a chief information security officer, the CISO, who reports up to the CIO.
How big is that team?
The source mentions it employs over 200 full-time staff focused just on security.
Wow.
They run a 247 Cyber Defense Center for monitoring and response and have a detailed incident response plan, an IRP.
And their strategy.
Their approach aligns with the NIST cybersecurity framework, and they use what's called a defense in-depth strategy, basically, multiple layers of security controls.
Now, you mentioned the Google Cloud partnership earlier.
Mhm.
Does the source connect that technology usage back to the cyber risk discussion?
It does, explicitly. The material states that their increasing use of cloud technologies, including that Google Cloud partnership, could potentially increase their cyber risk surface.
So, again, a trade-off they have to manage.
Exactly. It's part of their overall security framework and risk assessment.
Okay. Now, let's unpack their role as a central counterparty in clearing. That sounds essential, but also like it involves significant credit and liquidity risks. How does that clearing role work?
Right. So when they clear a trade, the clearinghouse, CME Clearing, steps into the middle. It becomes the legal counterparty to both the buyer and the seller.
So they guarantee the trade.
Effectively, yes. It means if one side defaults, fails to pay or deliver, the clearinghouse is still on the hook to the other side. This creates credit risk for CME Group itself.
That sounds like a huge responsibility. How do they manage that potential exposure?
They have pretty robust risk management practices as detailed in the source. First, they require clearing firms, the members who clear trades through them, to post performance bonds.
Which is basically collateral.
Exactly. Collateral could be cash or securities put up to cover potential losses if that specific firm fails. That's the first line of defense.
Okay. What else?
They also require mandatory contributions to guarantee funds. You can think of these like shared insurance pools funded by all the clearing firms.
So if one firm's collateral isn't enough?
Then the guarantee fund is tapped to cover the remaining losses. It mutualizes the risk to some extent.
And where does all that collateral actually sit? The source mentions restricted cash. That sounds important.
It is a key point. Cash collateral provided by clearing firms is held directly by CME Group, and because they hold it, it appears on their balance sheet as restricted cash.
Okay.
Now, the interest earned on this huge pool of cash initially goes to CME, although they do distribute a portion back to the clearing firms.
And non-cash collateral, like bonds or stocks.
That's handled differently. Non-cash collateral is typically held by third-party custodians. It doesn't appear on CME's balance sheet because the clearing firm still technically owns it. It's just pledged to CME.
I see the distinction.
And on top of the collateral, they perform a daily mark-to-market process every day.
What does that involve?
They recalculate the value of every single open position. Firms whose positions lost value that day have to pay in the difference, while firms whose positions gain value receive payments.
So it prevents losses from building up over time.
Precisely. It limits the potential accumulation of large losses before they become unmanageable.
Tell me more about those guarantee funds you mentioned. How are they structured?
The sources describe separate funds. There's a base fund covering most products, and then a larger separate fund specifically for interest rate swap, IRS products, which have different risk profiles.
And these are funded by the clearing members.
Primarily, yes. But critically, the sources highlight that CME Group itself makes corporate contributions to these funds. $100 million to the base fund and $150 million to the IRS swap fund.
And their own money is used first.
Yes, that's the key. Their contribution acts as an additional buffer and is drawn upon before they dip into the pooled contributions from the other clearing firms in the event of a default.
That seems like an important backstop.
It is. And then, for handling very specific, sort of extreme but possible scenarios that could cause temporary liquidity, needs like a major clearing firm default, creating short-term payment chaos, or a big disruption in the payment systems.
Right.
The sources mention they have committed multi-currency credit facilities available, basically bank lines of credit they can draw on quickly.
How large are those?
The sources mention two facilities totaling $7 billion and $2.3 billion. So substantial backup liquidity if needed for those specific crisis events.
Okay. Finally, on risks, operating all over the globe must present its own unique set of challenges, right? Beyond just market or cyber risk.
Absolutely. The sources list the inherent risks of global operations, things like fluctuating currency exchange rates impacting their financials.
Yeah, FX risk.
The sheer complexity of just complying with vastly different regulations in every country they operate in. Challenges in staffing global offices, finding the right people everywhere.
For environments.
Adapting to diverse economic, social, political conditions, potential protectionist policies by governments making it harder to operate, and even difficulties enforcing and protecting their intellectual property rights in some regions. It adds another layer of complexity.
Okay, quite a landscape of risks to manage. Shifting gears slightly, let's talk about the people and the governance structure. What does the material say about their workforce?
Human capital management is presented as a key area. They emphasize their reliance on a large, highly skilled workforce spread across the globe.
How many people are we talking about?
As of the end of December 2024, the source lists approximately 3,760 employees,
And where were they based?
spread across the U.S. and 14 other countries, so quite distributed. The documents also highlight their focus on the employee experience, things like benefits, a pay-for-performance compensation model,
Standard corporate stuff.
fairly standard, but also investments in development, tuition assistance, professional training, leadership programs are mentioned. They also use employee resource groups, ERGs, to help foster an inclusive culture.
Do they give any metrics on how they're doing with their workforce?
They actually provide a few for 2024 in the source, a 3.3% voluntary turnover rate, which seems pretty low.
Yeah, that's low.
28% of open positions were filled by internal candidates, suggesting internal mobility, and 15.1% of employees received promotions that year.
Okay, giving some concrete numbers there.
Yeah.
The sources also list key members of the senior leadership team, right?
Yes, it notes roles like the Chief Information Officer, Chief Financial Officer, Chief Operating Officer, the General Counsel, and the global heads of various asset class businesses. It also mentions some recent changes in roles for certain individuals.
Now, their shareholder structure sounds a bit unusual, maybe reflecting their history as an exchange. Can you break that down based on the source material?
It is unique. They have the standard Class A common stock. That's what most people would buy on the public market. But they also have Class B common stock. This is associated with owning historical CME exchange memberships from back when it was member-owned.
Ah, the legacy structure.
Exactly. And there's also a Series G preferred stock mentioned, though less detail is provided on that.
And the Class B shares seem to have special powers or rights.
That's the key distinction the sources highlight. Class B shareholders, sort of collectively, have the right to elect 6 members to the 22-member board of directors.
Regardless of how many shares they own overall.
The structure gives them dedicated board representation. They also have specific approval rights over any changes to certain core rights.
What are those core rights?
Things related to trading privileges on the exchange, fees, and membership benefits, basically protecting the interests tied to those historical memberships.
How were votes counted for that?
Their votes on these core rights are weighted based on the specific type of Class B share they hold, reflecting different historical membership classes.
Interesting. And for other matters?
For most other matters, the Class A and Class B shareholders vote together based on the number of shares held. So it's a hybrid structure, really.
As an example of their governance, the source details their personal trading policy. What's the gist of that? Why is it important?
Well, this policy is designed pretty standardly to prevent employees and directors from trading the company's own securities CME stock when they have access to what's called inside information.
Right. Material non-public information.
Exactly. Information that isn't public yet and could reasonably affect the stock price or influence an investment decision, preventing insider trading, essentially.
What kind of information counts as inside information according to the document? Do they give examples?
They do things like projections of future financial results, planned pricing changes for their services, potential mergers or acquisitions they might be involved in, upcoming dividend announcements.
Major corporate actions.
Yes. Also, significant changes in senior leadership, major legal or regulatory issues, winning or losing a really significant client, changes in their credit rating.
Even cyber incidents.
Yes. Even knowledge of a potentially significant cyber incident before it's publicly disclosed. Anything material and non-public. The policy requires mandatory pre-clearance for certain senior executives and directors, the Section 16 officers, before they can trade CME stock at any time.
They have to get permission first.
Yes. It also restricts these specific individuals from pledging their Class A stock, like using it as collateral for a loan.
Interesting. What about the Class B shares?
That's an interesting nuance mention. The source notes that Class B shares can sometimes be traded even during a company-wide trading restriction period if the person doesn't actually possess relevant inside information.
Oh, okay.
But they still require that pre-clearance. So, slightly different treatment reflecting their nature.
Okay, let's wrap up with a look at the high-level financial picture presented in the sources. How did the company perform recently, based on the numbers provided?
Looking at the comparison provided, specifically 2024 versus 2023, total revenues saw a pretty solid increase. They went from about $5.58 billion to $6.13 billion.
Decent growth there. And operating income.
Operating income also grew from $3.44 billion in 2023 up to $3.93 billion in 2024. So profitability improving. And that flowed through to the bottom line. Net income attributable to CME Group increased from $3.23 billion to $3.53 billion year over year.
Okay. What about their debt levels and their cash position?
As of the end of 2024, the source states they had approximately $3.4 billion in total debt.
Okay. Manageable number relative to income.
Seems reasonable given their earnings, their cash and cash equivalents balance, and this excludes that huge pile of restricted cash we talked about.
Right, the operating cash.
Yes, their operational cash was $2.9 billion at the end of both 2024 and 2023. Pretty stable.
And where do they keep that cash?
Primarily held in very safe, liquid investments like U.S. Treasuries and money market funds, according to the source.
And just to reiterate, that restricted cash figure tied to their clearing function, how big was that again?
Yeah, that number is immense and really highlights the scale of their clearing activities. At December 31st, 2024, the restricted cash held as performance bonds and guarantee fund contributions was a staggering $98.9 billion.
Almost $100 billion.
Almost. And again, it's on their balance sheet because they hold it, but it's absolutely not their money to use for general operations. It belongs to the clearing participants ultimately. Finally, just a quick note on taxes. The effective income tax rate mentioned remained quite consistent, hovering around 22.4% in 2024.
Okay. So bringing it all together,
Hmm.
what does this deep dive into the source material tell us?
Well, I mean, we've really delved into a company that sits at such a critical point in global finance, haven't we? Providing the essential infrastructure for trading.
And, crucially, guaranteeing the settlement of those trades.
Absolutely. Across just a huge, diverse range of products that touch almost every part of the economy.
And navigating what seems like a truly intense environment. Balancing sophisticated technology, global teams, global operations.
With fierce competition coming from all sides, layers upon layers of complex regulation.
And that constant, almost existential need to manage this wide array of diverse risks. Everything from cyber threats to counterparty credit defaults.
All while keeping the markets running smoothly, reliably, securely, day in, day out.
It's a fascinating interplay, isn't it? As you said, they need volatility to drive revenue, yet extreme volatility is a huge risk they have to manage.
Exactly. They rely on technology for absolutely everything, but that same technology is a massive attack surface they have to defend constantly.
And they provide stability through the clearinghouse function.
But that very function concentrates immense potential risk, which they have to meticulously manage through these colossal pools of collateral and guarantee funds. It's quite the balancing act.
Absolutely. It really drives home the complex engineering, the financial plumbing, and just the constant vigilance required to operate this, well, often invisible infrastructure that underpins so much of the global economy.
Indeed. And here's where it gets really interesting, something to maybe leave you, our listener, thinking about. Given the critical dependence highlighted in the source on those intellectual property licenses for major global indices, the S&Ps, the NASDAQs,
Yeah, those core benchmarks.
how might potential future shifts in the ownership or maybe the regulatory oversight of those fundamental benchmarks impact the stability, the accessibility, maybe even the nature of the trading opportunities that CME Group provides based on them? That structure isn't necessarily permanent.
That's a really interesting thought. The foundation relies partly on agreements that could potentially change.
Something for you to consider.